Hi, my name is Ian Watt. I'm a mortgage broker with Advanced Mortgage in Calgary, and I'm here at the Morrison Show Homes in Glacier Ridge to talk about affordability, how to qualify for your new home, and some changes that the government has made recently to make homeownership more accessible to everybody. Thank you for coming to the Morrison Show Home up here in Glacier Ridge today to learn about mortgages and affordability and how to buy a house, basically, is what we're here to talk about. I'll give you a little intro about myself. My name is Ian. I am one of the owners of Advanced Mortgage. That's my partner who's not here today, so he doesn't matter. But I've been a broker for almost 2 decades, about 18 years now. And I really do love working with first-time home buyers. That's one of my favorite things, is educating people and setting them on their path to home ownership. So that's why I love doing events like this. We are a independent brokerage. We do not work for any one bank or lender. We work with all the different banks, credit unions, and monoline lenders across the country. Those are lenders that do mortgages and nothing else. So you would never be able to work with them without a broker. In fact, you'd probably never hear about them without a broker. But we give you access to all those different companies. And working with the broker allows you to access not just what your bank offers, but allows you to access what every bank offers. And therefore, if you don't fit the policy of one bank, you might fit the policy of another one. So that's where the advantage comes in working with a broker rather than a bank. So that's just a little bit about me. It wouldn't be a mortgage presentation if I didn't talk about interest rates, so we'll talk about that briefly. Interest rates have fallen quite a bit over the last last year, basically. They have stabilized for the time being. Today was another interest rate announcement by the Bank of Canada, and they did hold the interest rates flat, and we expect that that's going to continue for the next little while. Most likely we'll see another drop before the end of this year. So that's kind of what we're thinking right now. But rates are pretty decent. Like right now, a 5-year fixed is as low as 3.95%, which is fantastic. 5-year variables are sitting at about prime minus 0.8. Prime is 4.95 as of today. So that's not quite as good as that 5-year fix, but still pretty aggressive. And we can do builder holds. If you're looking at buying a new build, we can secure you a rate for either 6 months or 12 months. Those rates you'll see are a bit higher, but that's just a safety net. So we secure that rate for you, and we hold it for 12 months, but when your house is ready, we'll find you the best rate in the market at that time. So if rates have gone down, obviously, we'll get you 3.95 or better. But what it does is it protects you in case something happens in the world and interest rates skyrocket. Now you're protected, and that's the worst interest rate that you could possibly get. So just like a little bit of a safety net. Typically, we never end up using that rate. We always end up getting you a better deal when your house is ready. Fixed versus variable, what's the difference? It's pretty straightforward. Fixed rate, you set it for a term, usually 5 years, sometimes 3. Your rate stays the same, your payment stays the same for that entire 5-year period. If you do select a variable rate option, every time the government makes an announcement, if that rate goes up or down, then the next month's mortgage payment that you make will be either higher or lower if that rate moved. So in an environment where we are today, could be a good idea to take a variable because there's a good chance they're going to go down. And the other advantage of a variable rate product is that you can lock in with your lender at any point in time. So take the variable today, wait until the rates go down in December, and then potentially phone your lender and lock in at a fixed rate that could be lower than that 3.95. So it gives you more flexibility. If you're in a fixed rate, you cannot, just change to a variable. It's fixed. The biggest part about mortgage qualifying is your income. How much money do you make, and what type of income? Are you employed, or are you a self-employed individual? If you're employed, it's pretty straightforward. Typically, you're on a salary, or you have an hourly wage with a guaranteed number of hours per week. If you make for $30 an hour times 40 hours a week times 52 weeks a year, that's what your income would be. It gets more complicated if you happen to be self-employed. If you are a self-employed individual, plan to file at least 2 years of tax returns with your business, and then we're going to use the average of what you've claimed over those last 2 years. And unfortunately, it's not the gross income when it comes to self-employed. It's the net income after you've deducted all those expenses to reduce your income tax. So it's a balancing act. You don't want to pay taxes. That's right, yeah. Don't make your accounting too creative, because the more write-offs you have, the lower your income is, the less you qualify for. So if you're planning to buy a house and you're self-employed, it may be in your best interest actually to keep those reductions a little less. Yeah, yeah. Claim more. Once you got the house and you're approved, then you can write off as much as you want, because your lender will always keep renewing you as long as you've been paying your bills, right? You don't have to qualify again. So that's kind of a brief overview of income. And why it matters is something really exciting called debt servicing ratios. But this is how all approvals are either approved or denied. And so your income, your gross income if you're employed, or your net income if you are self-employed, can only take up to a maximum of 44% for your total debt servicing. So there's gross debt servicing, GDS, super exciting. That is to do with your house. So that's your mortgage payment, your property taxes, and your heat. If it's a condo, it's your condo fees as well. All of that can only take up to 39% of your income. And then in addition to that, you may have credit cards, car loans, student loans. If we add all that in, then everything can only take up to 44%. So that's kind of how every lender qualifies in this country. If you have less than 20% down, those are the rules everywhere. If you do get to 20% down or above, there are a lot more creative ways that we can look at financing. There are alternative lenders, B lenders, private lenders, but if you have less than 20%, these are the rules, and they're pretty hard and fast. They don't change. Speaking of down payment, it's actually one of the more complicated pieces, believe it or not, but we have to get a 90-day history of all the money that you're going to put towards your house. So if that's just sitting in a checking or a savings account, that's pretty straightforward. But we have to track every deposit that is $2,000 or more. So if you move money from RSPs to savings to TFSA to checking, suddenly we have to track all of those accounts and get a 90-day history of each one. So we advise our clients to try not to move their money around too much if they're looking at buying a house. But more importantly, you can't have a cash deposit that we don't have a paper trail for. So if you, say, sell a bunch of gold, which happens more than you think that it would, and then you deposit it into your account, we have no way to prove where that money came from. And because the government has such strict rules on anti-money laundering and terrorism financing, we can't use that money. So if you do have a bunch of gold that you need to sell, sell it now and put that money in your account and leave it there for at least 3 months. So this messes people up a lot more than you would think. I had a guy last year sell a bunch of horses and deposit the money, and he had no bill of sale, couldn't prove that he owed them before. So I was like, I can't use this. So he had to wait a couple months to buy a house. Some questions that we get frequently about down payment is, well, the big one we get is, can I only put 5% down the first time I buy a house, and then every house I buy after that, do I have to put more? And the answer is no. You can put 5% down on any house that you are moving into. So as long as it's going to be your primary residence, you can put as low as 5% down on a resale house, 10% typically on a new construction. And then if you buy a new construction, 10% down, live in it for a couple years and decide, you know what, I'm going to keep this house, turn it into a rental, and buy another house, well, you can still put 10% on that next house. So you don't have to increase your down payment as long as you're moving into the property. If you're not moving into the property, if it's going to be a rental, then the minimum is going to be 20%. So something to keep in mind. And a big one that I love is, getting my credit checked hurts my credit score. Is that true or false? And the answer is complicated. So
True or false?
it's okay. I'm going to say false. I'm going to say false, because what matters is who's checking it. So if you go to buy a car, typically they'll take your application and they want you to leave the lot with the car that day. So they take your application and they send it off to 5 or 10 of their different lenders to get you approved right away. Often all those lenders will pull your credit at the same time. You get like 10 hits on your credit in one day. And plus it's for a car, which is a depreciating asset, so that hurts more. If you come to a mortgage broker, we check your credit. We check it one time, and then we can shop all of our lenders. And because we only sell what's considered good debt, or debt towards an appreciating asset, it doesn't take much off your score. Typically, I'll check someone's score to pre-approve them, and then a month or two later, they will go to buy a house, and I have to get a fresh credit report. I see their score has usually gone up, not down. So we are typically taking somewhere between 1 and 5 points off your score, and you recover that in less than 30 days, as long as you don't do anything bad like miss a payment or max out a credit card before you buy a house, which don't do that. So when people say, okay, you're pre-approved, but don't get your credit checked anywhere, it's because they don't want you to get a second opinion. They don't want you to go and find out if you can get a better deal somewhere else. So don't ever let anyone intimidate you into not getting a second opinion, because you always should. If you are considering buying a condo, what does that do? So, if you buy a condo, there are condo fees, and we have to factor that into that debt servicing conversation we had a second ago. And let's say if you have a household income of $100,000 a year, and you have $60,000 down, your max purchase price, if you have a $600 a month condo fee, is going to be around $480,000. Whereas if you were to buy, a duplex, or a detached home that has no condo fee, your maximum purchase price jumps up to $550. So $550,000 rather. So it makes a big impact. So that's important to consider if you are shopping in the condo or townhouse market. You may actually be able to afford a duplex or a detached starter home if you take that condo fee out of the equation. So just something to consider. Okay, the government has been really confusing recently and released a lot of new housing measures, so I wanted to discuss them a little bit so everyone's on the same page and kind of knows what they can take advantage of. The first-time home buyers withdrawal program has been around for a really long time. So you put money aside in your RSPs, and when you're ready to buy a house, you can take that money out. The limit used to be $25,000, and then it went up to $35,000, and then recently it was increased to $60,000 per person. So if you're a single individual, you can take up to $60,000 out of your RSPs. If you are a couple, you can each take that. So that could be $120,000 for two people. So that's a massive increase. And you don't have to start paying yourself back for 5 years. You do have to pay yourself back because that's your retirement savings. Again, when you do start paying yourself back, you do keep getting those tax credits. So it is a good thing to do. And you have 15 years to pay the whole thing back, which is quite a long time. Plus you do still want to save for your retirement, so you're going to do it anyway. And that change came into effect on April 16th, 24. So it's been around for a while, but most people don't know that it exists. So I wanted to bring it to everyone's attention. This is a new one too. If you are a first-time home buyer or you're buying a new construction home, you can now extend your mortgage from 25 years to 30 years. This is huge if you're looking at buying in a new community and buying a new construction home. That took effect August 1st, 24. And a longer amortization period means you're stretching out the repayment of your loan for a longer period of time, which means you can qualify for more house. And to look at what that looks like, if a family that had $110,000 income and $80,000 down were to buy before this rule change, they'd have a maximum purchase price of $575,000. And with no change to their financial situation, these new rules let them buy up to $615,000. So an increase of $40,000 just from that single rule change. That's really aimed at just making it easier for first-time home buyers to buy a home. Get off that rental, hamster wheel and stop giving their money away to their landlord and start saving it for themselves. So I think that's a really helpful change. They also changed the maximum insured price from just under $1 million up to $1.5 million. So that really is targeted to Vancouver and Toronto. But it does allow you to put less than 20% down on a significantly more expensive property than you used to be able to before. So as an example, if you had a relatively wealthy family making $125,000 each, total household income of $250,000, say they both take the $60,000 out from their RSPs for a total of $120,000 down. Their maximum price used to be just under $1 million, and then it got increased to about $1.28 million with that change alone. And then after adding, 1.2 with the 25 years, and then with the 30-year, all the way up to 1.285. So again, just trying to make home ownership easier, really targeted to the larger centers in Canada, but does make a difference. And then I want to talk a little bit about the product that we're in today. Is this the Carter I'm standing in? So the Carter, which is a 3-bedroom, 2.5 bath, and priced at $571, is if you have an annual income of about 108,000, that is what you would need to get into this product with the minimum down of 10%. And you are looking at a biweekly payment of $1,155, which is incredibly affordable, like incredibly affordable. And you could also look at building a rental suite in any of these properties. And another rule change, which is exciting, is that we can use projected rental income from suites that are not yet built. And we can use that to help you qualify for your mortgage. So if you can get, I think, what does a rental suite go for these days in this neighborhood? $1,400. So, we can add that $1,500 a month, times 12 months in a year, we can add that to your salary to help you qualify, which can make a massive difference. So that's a really good rule change that the government made. Before, you could only use rental income on suites that were already existing. So when qualifying for a pre-construction home, we couldn't use them until it was built. But now we can use anything that's projected. The Beckett is another one of the properties available in this area, kind of a similar price point, $583,000. And for that one, $110,000 income with 10% down, you can get into that one for $1,179 biweekly. So again, incredibly affordable. Like for a new construction home in Northwest, phenomenal. That's kind of the meat of my presentation, but I wanted to open up to see if there are any questions, anything you've ever been dying to ask a mortgage broker about financing. I know, we're very exciting people.
Awesome. What's the minimum time frame somebody could purchase, say, a condo at 5% or 10% down and then move in to purchase another new condo, turn that into a rental?
That's a very good question. I see where you're going with that. It's a very good question. And the answer is there's no real minimum. So as long as you do move into that property, I think that's the key. So, if to put less than 20% down, you do have to intend to occupy that property, and then you do need to occupy that property. There's no limit. You could technically move out a month later into another into another owner-occupied property and turn that into a rental. But the key there is that what they're going to be looking for is, are you buying another property that's the same as the one you just moved out of? Or is it actually a move up, like you're buying something nicer for yourself? So you do always need to be increasing in value as you move along that chain. Because if you, say, live in a $700,000 house now, and then you try to buy a $400,000 condo with the minimum down, they're going to look at that and say, why would you be moving out of this big, beautiful house into this condo? That doesn't make any sense. So it does have to make sense, as long as the story's there.
What if you change floors?
Well, that actually could make sense, right? That could make sense. You're in the same building, you got a better view, and you wanted to keep your...
As long as it's viewed as an improvement over...
Correct. Yeah, any justifiable improvement. And that would actually make a lot of sense because you would have a rental property in the same building you live in, which would be really easy to manage, right? So that's actually something we've seen happen. One thing to keep in mind, you can only have up to 3 insured mortgages at a time. So after the third one, you would have to do something to take the insurance off of one of them. So when you get an insured property with 5, 10, 15% down, you pay that insurance premium to CMHC, and it just gets added into your mortgage, so you don't really pay it out of pocket. So it does a few things. It gets you access to the lowest interest rates in the market, which is the most important one. If you put 20% down, you will actually pay a higher interest rate because you're not paying for that CMHC insurance, which protects the lender. So it's actually a higher risk loan. So you actually get a lower interest rate if you put less money down. So it's confusing, but it's true. But the other thing that it does is that insurance, as long as you don't refinance your house, to take money out of your house like it's an ATM, which you shouldn't do, that insurance stays in place. So 5 years later, when you come up for renewal, you can have access to those lowest insured rates again. And as long as you don't refinance the house, you can keep doing that for the whole life of the 30-year loan. So the cost of the insurance, over time, kind of ends up paying for itself if you continue to get the best interest rate for, more than just the first 5 years. If you get it for 15, 20 years, then you end up saving more than what that cost was. What I was saying is, if you are buying something with condo fees, you just need to remember that that is eating up some of your purchasing power because we have to factor that into your cost. So, when we're calculating your debt servicing ratio, it's, your mortgage payment, your property taxes. We estimate $100 for heat. That's because in the summer it's zero, but in the winter it could be, more. So it just levels out. But then if there's condo fees, we have to factor that in as well. So, condo fees are often depending on the property type, they're usually in the $400 to $600 range. But I mean, if you're looking at your mortgage payment only being $1,100, every 2 weeks, a condo fee of $300 every 2 weeks or $600 a month, like that eats up a lot of your mortgage qualifying. So it's just, we get a lot of people that don't think they can afford a home, but they're ready to pay $600 a month condo fees. And so it's important to have that. It's a lot, and you have to ask too. Sometimes we see them even higher, especially in the downtown buildings, especially if it has post-tension cables in it, which is a whole other can of worms. But if you see condo fees that are $800, $1,000, you also need to ask yourself, like, what has gone wrong? Like something has gone wrong. Either there were major repairs that needed to be done, and so they had to increase the fees. And is this problem truly solved, or are there other problems coming down the pipeline? Not to say that condos are bad. There are lots of fantastic condos you can buy, but it is, you have to do a bit more due diligence and do your research. Make sure that you are not buying into something that's going to end up costing you money. Because you want to not just buy a house to live in, you want to buy a house to invest in and to build your future. So if you're buying something, where there's a potential risk, you want to be really careful about that and mitigate it as best as possible. So condos, you just need to do a little more due diligence. Now, the condo market for resale has been really tough because there are so many beautiful new construction condos on the market right now. So reselling an older condo is a bit tougher. And there have been so many, in the suburban neighborhoods of Calgary, the market is actually doing better than it is downtown. Downtown, there are just far too many buildings that have come to completion in the last little while. So it's just that the market is cutthroat. But yeah, if you're further away, a lot of people don't want to live downtown anymore, actually. So the suburbs are doing significantly better than the downtown condo market. The Calgary condo market was flat for years and years and years, and then over the last 3 years, it really did come up quite a bit. And I think it came up quite fast, and so I think it's gonna just stay well, for the downtown condos, I think they will stay where they're at now for a while. You would be better to invest in a suburban condo than a downtown condo at this point. They would consider it the same as a condo fee, but townhouses often, their fees are less because typically in a condo, the fees include heat and lots of other maintenance. In a townhouse, they do still include lots of exterior maintenance, but they don't include the heat. And I find they just, generally speaking, have less issues structurally. So they typically are a bit lower. So they won't affect you as much. But yeah, it just depends on where that level is. You also have to be careful if you're looking at condo fees that are too low. Sometimes especially with townhouses, they may be priced as very, very low, and that's not going to stay that way. Just the cost of snow removal and exterior maintenance, like, it's going to go up. So if you have a $100 a month condo fee, plan for that to eventually be $300-400. Well, thank you so much for listening. I know mortgages are the most exciting topic. But, it's stuff we all need to know. It's not something they teach in school for reasons that are unknown to me. But if you have any questions, feel free to reach out to me anytime. My name is Ian with Advanced Mortgage. And I'm happy to help.